Welcome to the deep dive. Today, we're cracking the code on a fascinating, sometimes perplexing corner of the financial world. We're talking about how we put a value on things that aren't easily bought and sold, a bustling public market. Think of it, it's pretty straightforward to value a share of Apple stock, right? There's a price flashing on a screen every second. But what about a massive factory building? Or maybe a unique piece of land, or even the underlying value of a global brand's trademark? How do you assign a fair value to those assets that, well, they just don't come with a daily price tag? This session is all about pulling back the curtain on that complexity and the expert thinking required. Now, before we really dig into this topic, just a quick reminder for everyone listening. Our expiration today is built on material from Farhat lectures. To really reinforce today's insights, we've leaned heavily on the excellent resources over at farhatlectures.com. It's a fantastic place, really, for accounting students, CPA candidates, or frankly, anyone wanting to deepen their understanding with practice questions, video lectures, and more detailed explanations.
So our special thanks go to Professor Farhat for providing this valuable material. Okay, so let's start with the heart of the challenge then. We're talking about these non-financial assets. For our audience, many are deep into accounting. They know what these are, but perhaps we can highlight what makes them so tricky to value.
Absolutely. Yeah. When we talk about non-financial assets, we're largely discussing things like property, plant, and equipment. I mean, PPE, that's the physical stuff a company uses. Buildings, machinery, land. We're also looking at intangible assets, things like trademarks, patents, copyrights, and even commodities like oil or grain. The core challenge, the reason they, well, keep valuation experts busy, is exactly what you hinted at. It's the absence of a readily available active market. You just don't have that constant real-time price feed for a specific used drill press sitting in a factory in Ohio, not like you do for Google stock.
Right, right. And this brings us to an interesting point about accounting standards then. If there's no active market, is fair value always the go-to under different frameworks? What's the accounting perspective?
Yeah, this is a crucial distinction. Under U.S. GAAP, so the generally accepted accounting principles in the U.S., we often don't have to report most non-financial assets at fair value on an ongoing basis. Historical cost is frequently preferred, for reliability. However, for IFRS, the International Financial Reporting Standards, fair value reporting is much more common. It's often required, actually.
Ah, interesting difference.
It really highlights a kind of fundamental philosophical difference. U.S. GAAP leans towards reliability, while IFRS often prioritizes relevance. But, and this is important, even under U.S. GAAP, understanding fair value is absolutely critical for specific situations.
Like what, for example?
Like impairment testing,
No.
assessing if an asset's value has dropped significantly, or in business combinations, when one company buys another, those acquired assets must be recorded at their fair value.
Got it. That distinction is key. So, okay, when there's no constant market price and we do need to figure out fair value for one of those reasons, what's the fundamental principle? What's the North Star guiding that valuation?
The guiding principle, yeah, the North Star, as you put it, is highest and best use.
Highest and best use. Okay.
This means we value the asset based on the use by a theoretical market participant that would maximize the economic benefit or return from that asset. It doesn't matter if it's used alone or as part of a group of assets. It's all about optimizing its potential, really.
Optimizing its potential.
Yeah.
That makes me wonder, what kind of factors, physical, economic, do we need to consider to figure out that highest and best use? It can't just be what the current owner wants to do with it, right?
Exactly right. It's not about the current owner's, subjective desire or current use even. It's about what a rational market participant would do. So we consider the physical characteristics. What's its condition, its age, size? We look at its location. Is that factory in a booming industrial zone or maybe an area in decline? That matters. And we have to account for any legal, functional, or economic limitations.
Like zoning laws, maybe.
Precisely. A historic building might be physically sound, perfectly usable, but if zoning laws restrict its use to, say, only a museum, that impacts its highest and best use value compared to if it could be condos.
That's a critical nuance. It makes me wonder, does an asset always have its highest value when it's just used alone? Or can its value be completely transformed by being part of a larger whole?
That's a fantastic point. And it highlights a common practical challenge in valuation. Some non-financial assets, absolutely, they generate maximum value only when used in combination with other assets.
Can you give an example?
Sure. Think about a single, highly specialized machine on a large production line by itself. It might be virtually useless. Maybe it drills a specific hole pattern. Its true value, its highest and best use, only really emerges when it's integrated with all the other complementary machines in that assembly line. So when you're valuing that specific machine, you absolutely have to consider its contribution within that larger system. You can't just value it in isolation.
Okay, that makes sense. So even with these unique assets, the concepts we talk about with financial assets like principal market and most advantageous market, do they still apply here?
Yes, they absolutely do. The underlying logic holds. The fair value should still ideally be based on the principal market.
Which is?
That's the market with the greatest volume and level of activity for that particular asset. It's basically where the most willing buyers and sellers are likely to be found for that specific thing.
And if there isn't a clear principal market, maybe for some really specialized piece of equipment.
Right, that happens. Then we shift our focus to the most advantageous market.
Okay, and what defines that one?
This is the market that would maximize the amount received for the asset after considering the cost to sell it and any transportation costs needed to get the asset to that market.
And that's the key distinction right there, isn't it? Transaction costs.
What's exactly?
The principal market ignores them for the price, but the most advantageous market explicitly factors them in to find the best net amount.
Precisely. If we kind of connect this to the bigger picture, it's a consistent principle across both financial and non-financial asset valuation. It acknowledges that maximizing value isn't just about the raw price someone might pay, but what you actually, put in your pocket after all selling expenses are accounted for.
Makes sense. So given the absence of those real-time market prices we started with, how do appraisers or accountants actually arrive at these fair values? What are the practical valuation techniques they use day to day?
Right. Since a direct observable market price, what we call a level 1 input, isn't typically available for these assets, we rely on 3 broad categories of valuation techniques. Let's maybe use a commercial delivery truck as an example. Not just any pickup, but maybe a specialized refrigerated truck.
Oh, good example.
So first, there's the market approach. This method essentially looks for comparables. You use prices, other relevant info from market transactions involving identical or more likely comparable trucks.
So finding a similar truck that sold recently.
Exactly. If you can find a truly similar refrigerated truck that recently sold, that provides a good benchmark. The challenge, of course, is finding truly comparable sales, especially for unique assets. And then you have to make appropriate adjustments for differences in condition, mileage, features, refrigeration specs, that sort of thing.
Okay, that sounds like it often relies on observable data, but maybe requires some adjustment, level 2 territory.
Often, yes. This often aligns with what we call level 2 inputs in the fair value hierarchy observable inputs, but not directly quoted prices for the exact asset. Second, there's the cost approach, often called the replacement cost method.
How does that work?
This reflects the amount required today to replace the current service capacity of the asset. For our specialized truck, what would it cost to get a new truck that provides the exact same functionality? Or maybe what would it cost to acquire a used one with similar remaining service life and utility?
So you're looking at the cost to build or buy a substitute.
Essentially, yes. You'd consider the cost of new parts, labor for assembly if building, or acquisition cost of buying used, and then you'd adjust significantly for depreciation, physical wear and tear, obsolescence. This approach is often useful for newer assets, or perhaps those assets that can be, easily replicated.
Got it. And the third approach?
The third is the income approach. This is where we often get into discounted cash flows, or DCF.
Ah, the DCF method. Familiar territory for many.
Right. This involves looking at the future cash flows that the asset or truck is expected to generate over its useful life, maybe from its delivery routes, the contracts it fulfills, and then you discount those future cash flows back to a single current present amount using an appropriate discount rate that reflects the risk.
And that present value is the fair value estimate.
That discounted cash flow represents the fair value using this income approach. Now, this technique, especially for highly specialized or unique assets where future income is uncertain, often relies heavily on unobservable inputs.
Meaning management's own projections and assumptions.
Exactly. Significant management judgment is involved in forecasting those cash flows and choosing the discount rate. This often pushes the valuation into what we call level 3 of the fair value hierarchy, the most subjective level.
So let's recap that hierarchy quickly. Level 1 is active market prices, like stocks. Level 2 uses observable inputs, like those comparable truck sales maybe. And level 3 uses unobservable inputs, like the projections and the income approach.
That's a perfect summary.
So, okay, while we might not always report these non-financial assets at fair value on the balance sheet day to day under U.S. GAAP, understanding these techniques, market cost income, clearly illuminates the broader world of asset valuation.
Absolutely. Knowing how we tackle valuing these less liquid non-financial assets really puts into perspective how we determine the fair value of all assets, not just financial ones. It highlights the underlying principles, how we assign economic value, moving from concrete market data towards more subjective, yet still rigorously calculated estimations when needed.
So wrapping this up, what does this all mean for us? Today, we've really unpacked the complexities around fair value for non-financial assets. We've dived into concepts like highest and best use, understanding the different market considerations, and explored the actual techniques used when there's no easy price tag. It's a powerful reminder that valuation isn't always straightforward, is it?
Not at all. And what's fascinating here, I think, is how these seemingly technical accounting rules actually encourage a deeper form of critical thinking. It's not just about crunching numbers, right? It's about understanding an asset's true potential, its practical limitations, and how it functions within a larger economic context. It's really about looking beyond the obvious surface level.
And that raises an important question for you, our listener, to maybe ponder. If this highest and best use principle applies so rigorously to a factory machine or a piece of land, what does it mean to apply that same kind of rigorous thinking to your own resources? How might you strategically assess your own skills, maybe your time or even your capital, to maximize your return and potential in the long run?
Exactly. That's a great takeaway. Knowledge is really most valuable when it's understood and then applied. So keep exploring, keep questioning things, and keep investing in yourself. Just like those valuation experts, invest all that effort in understanding the true potential of an asset.